Welcome to the Sykes and Company PA video blog featuring Ollin Sykes. Today we're talking about 3 pharmacy business trends that you cannot afford to ignore. And as I understand, the first one pertains to payroll. Can you tell us more about that?
Absolutely. Gross payroll, as defined, is payroll to pharmacists, owners, techs, and clerks. And that number, in our view, needs to be in the 10 to 10.5% of gross revenues in order to optimize the profits of the pharmacy. Um, we have pharmacy clients today that run as low as 6%. We have those that run 17, 18%. And I don't need to tell you they're not profitable. And they are working hard to get that number down. But when you're in the 10.5% of gross revenues for your gross payroll, you're maximizing that labor cost to the degree that you can. And of course, you've got to take in consideration that does not include payroll taxes. That does not include payroll benefit costs associated, like health insurance, for example. And in the health insurance area, which is a major investment now, we're seeing most pharmacies cover about one half of the cost for the employee only. And that's typically the trend that we're seeing. But because payroll benefits and payroll taxes are such a significant part of the cost structure of a pharmacy, every opportunity when you have attrition to not replace somebody and to integrate technology into the process to become more efficient in the operation of a pharmacy, the better off you're going to be. And I might add that the payroll-related costs are typically about zero point 0.9 to 1% of gross revenue, and the related payroll benefits are typically somewhere in the zero point 0.8 to 0.9% of 1% cost of total accrued revenue. So, those numbers are really significant when you consider your margins with rebates maybe in the high teens, the low mid 20s. And that becomes a very significant part of that cost structure. And there's no single item you can control probably more in your pharmacy than the level of pharmacist or the hours that you're serving, the techs that you have at your side, the clerks that you have, the out front help that you have, or even the drivers that you have in delivery. But that's the most important item that I see that is trending to that number actually is trending lower, not higher, as there's a pharmacists that are using technology today more so than ever before.
And are most pharmacists, is it the technology that's allowing them to lower the payroll, or is it that they're changing their hours or making other changes?
Well, it's kind of a combination of all the above. We've actually seen some pharmacists. I had one in particular that I know changes hours from 8 in the morning. He actually opened his drive-up window at 8. Now his drive-up window still opens up at 8, but his retail store doesn't open until 9:30. He was closing at 7:30 at night. Now he's closing at 6. He was running to 6 on Saturdays. Now he's closing at 2 on Saturdays. He, I think, reduced his payroll some 20 some odd percent by making those changes. And that was significant for him because he was actually trending down his profits, and now he has completely turned his entire operation around because he's monitoring that. He's also, as others are using robotic script filling systems that are out there, icon counting type systems, anything that can be used to lessen labor costs internally in the pharmacist. Most of the robotic filling systems that are out there on the market, the Script Pros, the Parados, and there are other brands, are typically filling 50, 55, 60% of all scripts. So when you can take the top 200 drugs you dispense and you can fill half to maybe two-thirds of your scripts robotically, then you can see what it does with respect to your labor. And frankly, you can't afford not to have one when you have script volumes probably of 200, 225 or more on a daily basis. A lot of people argue about where that number needs to be, but there used to be like only one model of each of these. Now they all have 4 or 5 different models that you can kind of stage in at different cost levels so that they can actually help a small pharmacy as much as they can help even a larger pharmacy. But tying all this technology in to lessen the load, lessen the stress, lessen payroll is very, very important in today's environment, Rachel.
Great, thanks. And then our second trend that you can't afford to ignore has to do with perpetual inventory.
Yeah, the part and parcel of the technology arena is some of the cloud-based systems that are out there that ancillarily will take care of not only of your perpetual inventories in your single store or multiple stores, and also your optimizing purchasing so that while you may have a main wholesaler, and most stores do have a main wholesaler they deal with, many of these stores will ultimately kind of cherry pick who they buy, maybe 15, 20%, maybe even 10% of what they purchase from outside vendors. And these cloud-based systems now can set you up having your main wholesaler over here, and but at the same time, when you're ordering, whether it be brands or generics, can optimize what you are ordering, optimize that perpetual inventory in multiple stores, lessen the amount of cash investment to be utilized on the shelf, optimize that gross margin, and help you with that payroll arena cost that we just discussed a few minutes ago. And when you tie all of that together, it is a very sweet situation, and can save a lot of payroll in today's environment with independents.
That makes a lot of sense. And then our third trend that you have listed for us is optimally planning for retirement. Tell me a little bit more about how you can't afford to ignore that
Yeah,
trend.
yeah, it's a lot of pharmacists will start off maybe owning stores in their 30s and 40s. They'll start off maybe with a safe harbor 401k because some investment advisor has sold that to them, or some accountant has suggested that that's what they need. But as they move into their 40s, 50s, and even 60s, there are other products that are out there today that can be added to a typical 401k safe harbor. Products like a cash benefit plan or products like a defined benefit plan. Both of those products are typically designed primarily for pharmacists in their late 40s and 50s or even 60s that have maybe their debt structure a little bit better under control than those in their 30s when they're just starting out, and could put substantially more money into it than a safe harbor contribution, which is typically 3% of gross payroll. And if you don't continue to look at these things, keeping in mind that tax rates, both federal and state, are going up significantly. In fact, the maximum tax rates this year at the federal level, there's some like 400 changes that have impacted the 13 returns and 14. The rates are up about 9.5% on a non-published basis. You might say, well, I haven't seen much about that. You would say you would be right, because a lot of these rates are phase outs or disallowances at certain rate structures or income levels that you don't necessarily see on the surface and are definitely not published. But the rates are substantially higher. So we've got some states that are being taxed upwards of 55, 60% now, state and federal together. And when you get that kind of tax structure, and when you can put in substantial monies into retirement accounts, and you're not optimizing that for a 10, 15, 20-year period of time that you may be on the stores, you're really leaving a lot on the table.
Thank you for joining us today. If you want more information or have any questions, please feel free to contact Ollin directly.